Town Bank Mortgage, NMLS number 512138, is an equal housing lender. This podcast is for informational purposes only. And now, the man born with a 5 o'clock shadow and with the NMLS number 2028201. He is a gentleman. He is a scholar. He is
Tyler Cralle.
Well, it has been a long day for me. You're lucky I'm here. I might yawn at some point during the podcast. If you're watching, you'll know, but if you're listening, you might not even be aware of that. But welcome, everyone, to the Friday edition of Wilmington Mortgage. I am the aforementioned host of this podcast, Tyler Cralle, of course, loan officer, Town Bank Mortgage, right here in Wilmington, North Carolina, where we break down the top stories impacting mortgage rates every single weekday. Unless, of course, I'm on vacation, I'm sick, or it's the Azalea Festival. And it's neither of those. So here we are. And we got a lot to get to. It was a busy morning trying to keep up with all the news, even more so than yesterday. Well, yesterday we just had, or Wednesday we just had, we had a Fed day. But then before that, we had housing starts and building permits. Thursday was a little wild. We had jobless claims. We had GDP data. We had PCE. We had Bank of England. We had European Central Bank. All happening before 8:30, or actually at 8:30. We got like 3 reports at 8:30. And then before that, 8:15, I think, was the ECB. And then I think 7 a.m. was the Bank of England. So it was a busy morning, no doubt about that. A lot of moves in the markets. And here is the great news, is that today we actually saw a good day for rates. It's been a while since I've been able to say that. Slight reversal yesterday. The 10-year was down about 4 basis points, so not a complete reversal. It was up about 7 yesterday, but we're back under 4.4%. And then the 30-year, so Mortgage News Daily had their 30-year fixed rate index dropping 5 basis points after yesterday's 12 basis point jump. So in both cases, slight reversal, so good, but we didn't make up for all the craziness. And that was mostly because of oil. I mean, that's really what's going to be driving rates right now is oil. Because today we got some major reports that actually all should have, I would have thought, all things being equal. So let's say we're not at war with Iran, oil markets aren't doing what they're doing. Rates would have jumped, I actually think, on a lot of this data. And the fact that they fell was because oil fell, was that we saw, and I didn't look that way. Last night before going to bed, I think I saw oil spiking. I think it was crude jumped to like $126 a barrel. And I was like, oh no, this is going to be bad. And then today we saw a kind of pullback. And so we got Brent at 110 and crude at 105. So still above 100, but like I said, Brent back from the 126 that we were at last night. So oil is dictating a lot of this because, like I said, the data that we got this morning, not the central bank data, but the economic data for the United States was pretty good for the U.S., which would be a sign that the Fed would not be cutting rates because of the strength of the economy. So, all right, first off, inflation data. So obviously inflation can be a sign of growth in an economy. It's really just a reflection of a growth in money supply. As Milton Friedman always, I like to say, Milton Friedman famously said, inflation is always and everywhere a monetary phenomenon. So that's what's always causing it without, shocks in the system. Like every once in a while you can have like a supply shock or a demand shock, which will cause a temporary jump in prices, but you will get back to equilibrium once the other side of the equation is taken care of. If it's just straight up adding more money to the system, that's what's going to cause long-term inflation. Plain and simple. So inflation jumped. We had core coming in slightly above what they were expecting, 3.2% versus 3.1. And then PCE, the headline, 3.5 versus 3.3 is what they were expecting. I mean, that's a big number. 3.5. That's almost double the target rate. That's a problem. So that is 100%. That alone, if we had gotten those numbers, all things being equal, prices or rates are up. So clearly markets were like, whatever. And a lot of that is being caused by the supply shock in oil that we are seeing. So we got that. That came out at 8:30. Then also at 8:30, jobless claims fell unexpectedly. I think they fell like 27,000. 186,000 is how many jobless claims we had last week. Lowest level, 1969. Lowest level since 1969. Clearly, these layoffs that we've been seeing are not impacting the labor market. They're not being felt yet. I don't know what's going on. Lowest level since 1969. That is crazy. Like I said, that after we got out of COVID, so we had the spike in jobless claims in 2020, right? When like everyone went unemployed that 1 week. And then, it came back down and then hit like 30, 40-year lows. So this means that the job market is better than it was, which is clearly not the case. I don't know if this is just like an anomaly or what happened, but lowest level since 1969. That's crazy. All right, so those are not indicators that we should be lowering rates, okay? Just plain and simple. And then we get the third report, which was GDP. Now, this is a big one, right? Because looking at the economy, how's the economy doing? U.S. growth in the first quarter, this is the first look, so we could see some changes by the third estimate. Better than expected. First quarter GDP growth, 2% annual rate. That is up from the 0.5% that we saw in the fourth quarter and was better than the 1.8% that economists were expecting. It was somewhat broad-based. Investments, exports, consumer spending, and government spending all contributed to the increase. That's pretty good. So, all three of these reports would cause rates to rise in normal circumstances. Solid economic growth, solid labor market data, and inflation rising. And yet rates fell. Why? Because oil markets. 100%. That's what it is. It's oil markets. And so as much as I'm such a fan of all these economic reports and I study them and I see, what does this mean long term? Right now, we are being controlled by the oil markets. Rates are. They're going to rise and fall by what's happening with oil. Plain and simple. Doesn't mean we can't enjoy the reports and read them. And, because the minute this thing gets worked out and oil markets go back to normal, all of a sudden these reports are going to matter a lot more. We're going to have to go back. But we're already going to be talking about them, so we're not going to have to go back. And then we did get a rate decision from the Bank of England and the European Central Bank, both of which held rates. But the Bank of England did something interesting. They actually laid out like 3 scenarios for what they saw happening going forward, and talk about a swing. So in the first scenario, which was the most benign of the scenarios, oil peaks around $108 a barrel with limited spillover into wages and broader prices. Oh, it's not $108, 108 euros or pounds, excuse me. So it's actually higher. Because when I was reading this, I was like, wait, we're already above $108. I was like, oh, wait, no, pounds. That's different metric. And I think, trying to think, what is it? I can't remember exactly what the exchange rate is, but obviously, at one point I think we were close to parity, but not so much anymore. So they got 108 pounds, limited spillover into wages and broader prices, pushing inflation to about 3.1%. Scenario 1. Scenario 2, little bit of an impact, those secondary pressures, inflation rising to 3.2%. And then worst case scenario, oil climbs 130 pounds and inflation expectations become unanchored, sending inflation as high as 5.6%. Those are quite the scenarios. The first two are like, okay. And then the third's like, geez. So, I just thought it was good that the Bank of England laid out those scenarios. But the first two weren't that different. And then the third was like, holy crap. So laying those scenarios out there. So big margin of error there for what could happen. A lot of ground there in the middle that we could see happening. But yeah, the Bank of England, ECB both held rates where they are. Okay, in my opinion, the biggest story of Thursday was none of this. Not oil markets, not rates falling. It was a report. Wall Street Journal reported on this. Look into the numbers. As of March 31st, the country's publicly held debt was $31.265 trillion, while GDP over the preceding year was $31.216 trillion, which would put the debt to GDP ratio at 100.2%. It has not happened. That has not happened since 1946. And that was because of World War II. And while we are fighting a war with Iran, that is not World War II or World War III, contrary to what some people want you to think. So our spending levels reaching that point are a problem. Now, the Journal, Richard Rubin over the Journal wrote this piece. He also did mention that we did cross that threshold during a moment during COVID when economic growth significantly pulled back and spending skyrocketed to pay for stimulus. And we did cross over, but it was temporary. And when growth, jumped back up, spending dropped, it wasn't an issue anymore. I mean, it's still high, but so now we're at 100%. And this is a big deal, like long-term implications. This is a big deal. The government is spending $1.33 for every $1 that it's bringing in. We're projected to run another almost $2 trillion deficit. And once again, we're not in the middle of a world war. We're not facing a recession. So there's no reason we should be spending, there's no temporary spending. That's sort of the problem. Is World War II, that was temporary, right? The war at some point was going to end. COVID was temporary. All of these spending jumps were temporary. This debt is not being caused by temporary expenditures. It's being caused by just our overall systematic problem, which is we're spending too much money. And many of these programs, like our biggest expenditures, right? Social Security, Medicare, are going to get worse. Those numbers are going to increase. And so this is a big problem. Rubin mentions in the piece, $1 in $7 of federal spending now goes to interest. A 0.1 percentage point interest rate increase would cost us $379 billion over 10 years. So about $38 billion a year. A 0.1 percentage point increase. This is a big deal because, once again, going back, we started supply and demand. Bonds are no different than any other product. And so we sell bonds and we need people to buy those bonds. And sure, America is number one, baby. We are. We're the number one place to park your money. Treasuries are the closest thing to cash without being cash. They're safe. Everyone wants them. But there's a limit. There's a limit. And at some point, people are going to get concerned about our debt level. They're going to get concerned about how we're going to pay it back and service this debt. And so, I've said this. We can't cut our way out of this. It's too systematic. The only way we got to grow, and we need like a second, I've told people this for years, we need a second industrial revolution, like an AI revolution that's going to cause productivity to skyrocket. Very similar to how we got out of World War II, of course, the spending fell off. And then we had that big economic growth. But we're going to need something like that where, so what's our debt? 31 trillion. Our economy is 31 trillion. So if our economy is now a $60 trillion economy because of AI and productivity and growth and everything else, then all of a sudden $31 trillion is not that bad. And I don't see how now we also have to cut spending. And I do think one of the unfortunate realities was the epic PR disaster that was Elon Musk's Doge, is that despite all of the headlines and everything, they didn't really do anything. They didn't really cut any spending. I mean, they got rid of U.S. aid, right? But they didn't do anything else. I mean, so, Biden was running a $2.1 trillion deficit, and now Trump's running a $1.95 trillion deficit. It's like, when Elon first started, it was like, we're going to cut $1 trillion out of the budget. And then by the end, he was like, hey, it was great. We cut $10 million out of this one program. So, I mean, but it gave off the impression there were all these massive cuts, and they didn't cut anything. That's why it was a PR disaster, because they didn't cut anything. And evident by our ongoing deficit. And so this needs to be fixed, because it's going to lead to higher rates. People are going to say, you know what? Maybe I don't want to park my money in the U.S. anymore. Now, luckily, China's going through some economic problems, and so that's going to help us maintain our economic edge on every other country. But we will reach a point. I don't know when that is. I mean, it might not be in my lifetime, might not be in yours. I don't know. But we're going to get there. And the result is higher rates. People are going to say, all right, I'll buy treasuries, but I need more interest. And because everything's kind of based off treasuries, all other rates are going to go up. Everything, including mortgage rates. And so this isn't like a now problem, like, oh my God, we got to solve this like the oil markets are. This is like, this is going to be a problem over the next, 20, 30 years, maybe 10. But it's going to be a problem at some point. And it's going to be the biggest problem. And no one cares. Neither party cares anymore. I remember debt used to be a huge issue. I remember people bragging about Clinton, which wasn't necessarily true. I mean, we did see a significant reduction. A lot of it was smoke and mirrors. Not his fault. I'm not blaming Clinton. A lot of it was a lot of money pouring into Social Security, giving us extra money in the Treasury. And I always tell people, if you look at the actual data, the national deficit never fell, because a lot of it was Treasury money or Social Security money, which is basically borrowed from Social Security. And so even though we saw technically a balanced budget, the liabilities increased. So we still owed that money. And so, like I said, it wasn't on purpose. It was just the way the system is set up. But I just remember, oh my gosh, everything was going to be solved. And then when Bush was in office, Democrats were talking about debt, and then Obama got in office and did stimulus packages and everything else. And so then Republicans made an issue about debt, and then it all just kind of went away. And then no one cares now. No one cares about debt. And we really should, because it's going to be a really big problem. And the quicker that we figure out what we're going to do, the better off. If we wait till the end, it's going to be a disaster, which it looks like we're going to do. So not all that surprising, but that's it. We're done. I'm exhausted. Whew, man, it's going to be a good weekend. Oh, who you got in the Derby? Which horse you going with? Actually, I didn't even look. I got to look. I don't even know. So go all. Yay. Go team. I'll be like Rob Lowe with the NFL hat. I always have like Kentucky Derby. I'm not even rooting for a horse. No, enjoy the Derby this weekend. One of the best sporting events in my opinion. Just totally awesome. Just everything, the pomp and circumstance is always kind of fun. So have fun there. And then we'll be back Monday for another edition of Wilmington Mortgage. And remember, as always, do not wait to buy real estate. You buy real estate and wait.